You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank global banking and markets leaders designed to provide you with timely insights and analysis. While U.S. COVID case numbers have risen drastically over the last few months, the U.S. dollar has slid, with the U.S. dollar index off over 10% since its March peak. Typically, in times of global crisis, the dollar acts as a safe haven, but there are several forces at play this time around that are contributing to dollar depreciation. On this episode of Market Points, Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank, returns to the podcast to triage the ailing greenback. Hi, Shaun. Welcome back to the podcast.
Hey, Greg. Great to be here.
So the last time we had you was back in May, and that was right before we saw a slide in the U.S. dollar and, of course, this pickup in the U.S. Issues with the pandemic. Lay out sort of that connection between the currency and the economic situation.
Yeah, I think there are a number of factors that have kind of come together all at once here over the past few weeks to push the US dollar down. The first issue, I think, is the aggressive monetary policy easing that's been implemented by the US Federal Reserve and the huge liquidity overhang that this represents for the US dollar. US interest rates have dropped very sharply as the Fed has pushed interest rates down to effectively close to zero. And that's removed one of the key pillars of support for the US dollar that's been in place over the past few years. And that is effectively the fact that the US dollar has benefited from superior interest rates compared to its peers. Most major central banks now have key policy rates set at or very close to zero. And in real terms, that's to say adjusted for inflation, 10-year bonds in the US are now lower, real 10-year bonds in the US are now lower than those in Japan. And the spread in real terms over core Eurozone bonds has narrowed significantly. So the low US yields have in effect undermined the attractiveness of the US dollar for investors.
How do those lower rates and other Fed action with respect to U.S. dollar liquidity contribute to a dampening of the U.S. dollar safe haven effect?
Yeah, I think it's an important consideration in the light of what we're talking about. I think there's a couple of aspects to this. Firstly, lower yields globally have forced investors to re-embrace riskier assets. So after the big crash in equity markets, we've seen a very significant rebound in global stock markets to the point that US equity markets are effectively very close to the high point we had prior to the crash. Low yields provide a backstop for equity markets, and in other words, and for risky assets generally. And that's produced a very benign investment environment globally. So there's less demand for the US dollar from a safe haven perspective. The second important aspect of this relates to another measure the Fed has taken to, I think, ensure that there's adequate liquidity in offshore US dollar funding markets. We saw very early in the pandemic that markets started to seize up, and people were reluctant to lend to counterparties because they were unsure of what was ahead, or they wanted to hold that dollar liquidity for their own purposes. And that drove a significant tightening in overseas funding markets for US dollars. And that also helped drive the US dollar higher. The Fed's response to that situation was to ensure that there's adequate dollar liquidity in overseas funding markets by enhancing its swap lines, its US dollar swap lines, with other central bank counterparties in Europe, in Asia, and Latin America, to make sure that markets had ample access to dollar funding, and that's calmed down that tightness that we've seen in dollar funding markets significantly over the past few weeks. So that has, in effect, undermined another aspect of the dollar's safe haven credentials, the liquidity premium that investors often place on the dollar in times of uncertainty.
You've written about the U.S. dollar smile when it comes to safe haven on one hand, economic performance on the other. Can you perhaps expand on that and explain it for the listeners?
Yeah, the dollar smile is a kind of interesting story for the dollar. It's probably not great podcasting material because what I'm going to do, Greg, is to ask you to try and imagine a smile, a curve, a broad sort of U shape. And on one slope of that smile, representing appreciation, we have a global backdrop characterized by weak economic circumstances and weak risk appetite. In that situation, the US dollar would tend to appreciate due to its safe haven status. On the other side of that slope of the smile, representing another cycle of appreciation for the US dollar, we tend to have a situation where the US economy is outperforming and the Fed is maintaining a relatively more hawkish monetary policy stance. In that situation, the US dollar would also tend to outperform. So you have these two extremes on either side of that smile, where the dollar typically would tend to appreciate. The low point of that smile or the curve is the trough between those peaks, and that represents typically a phase of the US dollar underperformance, a situation effectively we're facing right now. That's to say, where we have a dovish Fed, a benign investment environment, so no safe haven demand for the US dollar, relatively weak US economic prospects, and in that environment, the US dollar would tend to depreciate. And that's effectively, I think, the situation that has emerged over the course of the past few weeks.
So where then does that leave the U.S. with respect to expected economic performance, and how has their actions over the last couple of months been a negative contributor to that?
Yeah, so I think we talked about US interest rates a moment ago. And I think when we think about the dollar and how it's performed over the last few years, there's a couple of key aspects to the dollar's performance, or three aspects, I would say. One being interest rates, and superior interest rates relative to much of the rest of the world in the US. The other factor has been the safe haven demand for the dollar in times of uncertainty or when we have a liquidity crunch. And the third aspect of this is generally superior rates of US economic growth. And that's where I think the kind of third and final pillar of what has been a very supportive environment for the US dollar over the last couple of years is looking much less attractive now. Effectively, the US economy is slipping down the growth rankings for 2021 as we look into next year. Currently, if we look at the consensus expectations for the US, the US economy is expecting growth of around about 4% next year. That's according to the Bloomberg consensus. That's okay, but Japan, among the large economies at least, is expected to, only Japan rather, among the large economies, is expected to grow more slowly. So that's to say we have growth expectations in Europe, in Canada, in the UK that are quite significantly superior to that of the US. And more importantly, perhaps, we've seen growth estimates in the US being shaded back by a few tenths of percentage points over the past few weeks, whereas growth expectations for Canada for 2021, for example, at around about 4.8%, are actually improving a little bit. Eurozone and UK are expected to grow around 5 to 5.5%, maybe a little bit more than that overall in consensus expectations for next year. So the US has slipped down the growth expectations rankings, and that will have an effect of, I think, driving investors away from the US and US dollar denominated markets as they seek better returns and more dynamic growth elsewhere.
Why is it that the U.S. isn't expected to make a comeback like the rest of these economies?
I think it goes back to a situation we've kind of in now. Now we're through presumably the worst of the pandemic. It seems quite likely that the global economy most likely troughed in the second quarter of this year. And now I think we're in a situation where investors are starting to note and pay attention to how effective the various governments' pandemic management and fiscal support measures have been, and how these measures set effectively these economies up for the recovery phase now, and who's going to emerge effectively first or in better shape for 2021. And I think when we look around the world, the US response has been somewhat muddled in terms of trying to manage the COVID-19 outbreak. Arguably, its fiscal response, although it's been very generous, has perhaps been less targeted, less effective, perhaps, than other parts of the world. Canada and Germany, for example, have focused more on job retention schemes to ensure that industry is well equipped and well supplied with labor, and labor is ready to go, in effect, once the green light is switched on to restart the economy, whereas US companies have tended to lay off people, and the support packages there in the US effectively have been targeted more at unemployment benefits and less so at job retention schemes. So I think it's a reflection of the expectation that some of these economies outside of the US, namely Canada and perhaps the Eurozone, are in a better position to get back up to speed more quickly, perhaps, than the US is at this point in time.
Is there an election year effect at play here as well? What's your thoughts in terms of how the dollar would normally react in an election year versus, let's say, this particular election year?
Yeah, the election's a kind of interesting thing because it's obviously it's clearly a big concern and a big focus for investors. Every time we get into this, particularly this part of the election cycle now, just a couple of months away from the real start of the election campaign, and it's difficult to detect a clear pattern for the US dollar as we run into the elections. The dollar has tended to kind of move essentially all over the place in the election cycles of the last 30 or 40 years. So there's no clear pattern. In this, obviously, a lot depends on economic circumstances at the time, what the kind of market preference is for the preferred candidate, so to speak, to win, who's going to have the better market-oriented policies, all those kind of things come into effect. I think this year, at the very least, we're likely to see probably a bit more volatility in the currency markets than we usually see in the run-up to the election itself, just because this has been a rather unusual period. It's probably going to be a rather unusual election campaign. And I think that lends itself to a situation where there's probably a little bit more uncertainty about the outcome and possibly a little bit more volatility in the US dollar.
With everything that's been going on, this has sort of increased the chatter with respect to the US dollar at the tipping point of losing its dominance as a global currency. What are your thoughts on that?
Yeah, it's an interesting topic of discussion that has come up a fair bit in our discussion with clients recently. There's been a fair bit of press, I guess, on this. The dollar has wobbled a little bit. It's not weakened severely. I think people, every time we see these kind of wobbles in the dollar's value, there is a concern emerges about the dollar's status as the global reserve currency. We've seen that kind of thing in the past, and I think what worries people is that these kind of regime changes in history have happened relatively quickly. Although they tend to evolve very slowly, the actual change in regime happens actually very quickly. That was certainly the case with the pound sterling when it lost its reserve status in a space of 10 or 15 years or so in the 1920s and 1930s, and was replaced by the US dollar, for example. I don't think there's any evidence really to suggest that the dollar's likely to be knocked off its reserve currency pedestal anytime soon. I think, firstly, we have to remember the dollar remains very deeply embedded in the global financial architecture. Credit markets are dominated in issues in US dollars, for example. Major commodities, gold, crude oil, most metals, for example, most soft commodities as well, are priced in US dollars. The dollar comprises one leg of nearly 90% of global foreign exchange transactions these days. And central banks maintain a very significant share of their reserves in US dollars, nearly 60%. And that proportion has actually remained relatively steady over the last few years. So there's no clear sign that the dollar's losing its reserve status at all. The dollar is a floating exchange rate. It has been since the 1970s, the end of the Bretton Woods system that prevailed in the post-war period. It tends to appreciate and depreciate in long-term cycles over time. And all I think we're seeing at the moment is the manifestation of the early stages of a weak dollar cycle. So I think that's an important consideration. The dollar may soften up a little bit more, but I don't think this is the end of the dollar's reign, if you like, as the major reserve currency of choice. I think we also have to think about who might replace the US dollar if it was to come to that. The euro and the yuan are possible candidates, but the euro is still a relatively young currency. It's only 20 years old, still facing some fairly significant growing pains. And the Chinese yuan itself at the moment is not fully convertible. So it's unlikely that's in any position to usurp the dollar at any point in the near future. I think the dollar is essentially likely to remain king of the FX hill for some time to come.
During this current depreciation of the US dollar, how has the Canadian dollar performed relative to the other global currencies against the US dollar?
It's been a bit of a disappointing year, I'd say, overall for the Canadian dollar. The Canadian dollar actually just in the past couple of weeks or so has kind of slipped to the low point or the bottom of the year-to-date performance league of the major currencies versus the US dollar. So it's had a pretty soft run overall. I think to some extent, as investors have moved away from the US dollar over the last few weeks, the Canadian dollar has kind of got tarred with the same brush effectively. There's been perhaps more of a sell North America trade going on as opposed to a sell US dollar specifically trade. The Canadian dollar has tended to get pulled down effectively in alongside the US dollar as the US dollar has depreciated against the likes of the yen, the euro, and the pound sterling effectively. But it's also lost ground against its commodity cousins, the Australian dollar and New Zealand dollar as well. So this hasn't been a particularly good run for the Canadian dollar. I do think it's looking a little bit undervalued. Our valuation models are struggling a little bit with the volatility that we're seeing in markets at the moment and the various aspects that of this situation that we're dealing with from a fundamental point of view. But when we did run the valuation model a week or so ago, it did suggest that the Canadian dollar is looking quite significantly undervalued. Our fair value model suggests that we should be trading somewhere closer to 130 at the moment. Right now, as we record, we're trading around 133. So we do think there's a little bit more upside in the Canadian dollar, a bit of catch up to come, given that oil prices have strengthened. Canadian relevant commodity prices recently have appreciated or risen in value, and that should be good for the Canadian dollar. I think the Canadian data as well have not really been given as good a shake by the markets as perhaps they should have. We've had some fairly decent employment numbers in Canada recently that shows we've regained a little over 50%, close to 55%, I believe, of the jobs lost during the downturn. And that compares with around 40% of jobs regained in the US. So we seem to be a little bit ahead of the curve, in effect, relative to the US. And I don't think that's in the recovery process, that's to say. And I don't think that's really been fully reflected in the Canadian dollar at this point. So we think there's a little bit more upside in the Canadian dollar to come. It may be a bit of a slog to get there, just because we seem to be facing some headwinds at the moment that difficult for me to account for, just because I look at factors that, to me, suggest the Canadian dollar should be appreciating at the moment. But at the very least, that should mean, I think, that the Canadian dollar doesn't see an awful lot more downside right now. It should, I think, manage to squeak out another cent or so higher over the course of the next few months.
So taking all of this into account, how's this impacted your 2020-21 forecasts?
Yeah, we've tweaked our numbers for the currencies, excluding the Canadian dollar, a little bit, given that we have seen the US dollar slide. We generally have been on the more negative side of the forecast range for the US dollar over the course of this year and into next year, but the dollar has obviously moved quite a bit in just the last few weeks. So we think we'll probably end this year around 118 against the euro, and the euro will appreciate towards 121 in 2021. For the Canadian dollar, our numbers unchanged versus the last forecast round. We expect to end this year around 132 against the US dollar, and for the CAD to pick up a bit more ground next year and edge down to, or dollar Canada should edge down to 128.
That was Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. You can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.